We often think of optimizing a portfolio as a sterile, numbers-driven exercise, a vast spreadsheet filled with ticker symbols, percentages, and projections. It's an image of pure calculation, detached from the messy reality of human emotion and market unpredictability. But what if I told you that this spreadsheet is merely the blueprint, and true optimization lies not just in the individual lines, but in the very architecture of how those lines connect and interact? This is where the conventional view falls short. It focuses on the components, the individual bricks, but neglects the mortar, the foundation, the structural integrity that allows a building to withstand the storms. Our ambition for sustainable growth, for wealth that compounds, not just over years, but across generations, demands a deeper understanding. It requires us to acknowledge that, as Benjamin Graham wisely observed, the investor's chief problem is never the market itself, but rather his own emotions and behavior. This truth extends profoundly into how we construct our portfolios. Our inherent biases, our fears, our very human tendency to chase the latest trend or flee from perceived risk can subtly, insidiously sabotage even the most mathematically sound allocations. This is why we're moving beyond the spreadsheet. We're introducing a framework of 7 strategic approaches to portfolio optimization. These aren't just tactics, they are principles designed to build resilience, to maximize the silent power of compounding, and to navigate the inherent uncertainties of the market with a quiet, data-driven conviction. We will demystify strategies that often seem out of reach, reveal hidden levers for growth that are frequently overlooked, and empower you to architect a portfolio that works in harmony with your long-term aspirations, not against them. Prepare to see your investments not as a collection of assets, but as a carefully constructed system poised for enduring growth. We often hear that diversification is the golden rule, the ultimate shield against market downturns. And indeed, spreading your investments across different asset classes can smooth out returns. Yet, history shows us that during truly systemic crises, the kind that shake the very foundations of global finance, correlation tends to spike. Suddenly, many of your diversified assets move in lockstep, offering little protection when you need it most. This is where the concept of tail risk hedging emerges, not as a mere insurance policy, but as a strategic architecture for resilience. Think of it as engineering your financial foundation to withstand an earthquake. Tail risk hedging is a deliberate allocation designed not just to protect your capital when extreme, low probability events strike, but potentially to profit from them. These are the black swan events, the unforeseen disruptions that can wipe out years of gains. While these events are rare, their impact can be devastating, and relying solely on traditional diversification leaves you vulnerable. The common objection is the perceived cost. Why pay for protection that might never be used? This is a fallacy. The premium paid for tail risk hedging isn't an expense. It's an investment in capital preservation, much like the premiums you pay for home insurance. You don't lament paying for home insurance if your house never burns down. You simply have peace of mind. We can explore cost-effective methods for this, such as strategic use of put options, inverse exchange-traded funds, or even managed futures, all integrated in a way that doesn't significantly dilute your core investment returns. The true cost lies in being unprepared for the unknown unknowns. It's about confronting the unconscious limiting belief that extreme events won't impact us, and instead building a portfolio that can absorb shocks and perhaps even thrive when the unexpected occurs. For decades, the pursuit of investment returns often boiled down to capturing beta, the market's overall movement. It's the idea of simply tracking an index, like the S&P 500, assuming that by owning the market, you'll achieve market-like returns. While this approach has its place, it often leaves a significant portion of potential growth on the table. It's like driving a car that's programmed to go at a certain speed, regardless of road conditions or engine efficiency. This is where smart beta strategies enter the conversation, offering a more nuanced approach to harnessing alpha, the excess return above the market benchmark. Smart beta isn't about chasing speculative trends. It's about systematically targeting specific investment factors that have historically demonstrated a statistically validated ability to drive long-term outperformance. We're talking about factors like value, identifying companies trading below their intrinsic worth, momentum, recognizing assets that are already in an upward trend, quality, focusing on companies with strong balance sheets and stable earnings, and low volatility, seeking assets that historically exhibit less price fluctuation. These aren't fleeting fads, they are deeply rooted characteristics that have, over extended periods, rewarded investors who systematically incorporate them. Consider the hidden incentive within traditional index funds. By definition, they often overweight the largest companies, which can sometimes be the most overvalued. This inherent tilt can act as a drag on overall portfolio growth. Factor-based investing, conversely, allows us to build portfolios that are tilted towards these statistically proven drivers of return. Practically, this can be achieved through a variety of exchange-traded funds and mutual funds specifically designed to target these factors. The key is to blend these factor exposures thoughtfully, creating a diversified approach that aims for enhanced performance beyond simple market beta. It's about optimizing the engine and aerodynamics of your investment journey, extracting more robust performance from the road ahead. We are often conditioned to believe that safety lies in numbers, that spreading our capital thinly across a vast array of assets is the wisest path. This can lead us into a trap, a subtle form of diversification driven by the pervasive fear of missing out. When we chase too many disparate opportunities, our focus fragments, our oversight diminishes, and our potential for outsized returns gets diluted into mediocrity. It's like trying to water a garden with 1,000 tiny sprinklers, each delivering only a trickle, when a few well-placed, powerful streams could truly nourish the soil. The alternative, often misunderstood, is the power of concentrated conviction. When rigorous, data-driven due diligence uncovers truly exceptional opportunities, businesses with durable competitive advantages, strong management, and compelling valuations, allocating capital with focus can unlock exponential growth. This isn't recklessness, it's the application of venture capital principles within the public market context. It's about identifying those rare gems and giving them the capital they deserve to shine. True safety, you see, doesn't come from the sheer quantity of holdings, but from the depth of your understanding and the strength of your conviction in those holdings. It arises from a disciplined process of identifying high conviction ideas, meticulously determining the optimal position size based on risk and reward, and establishing clear, objective exit criteria long before emotions can cloud judgment. Imagine an analytical skeptic, not prone to hype, who understands that a select few high-quality businesses, held with unwavering conviction through market fluctuations, often significantly outperform a sprawling, unfocused portfolio that lacks depth and clarity. This is about strategic allotment, not indiscriminate distribution. The relentless march of time is a powerful ally in wealth accumulation, but its force can be significantly blunted by unseen adversaries, taxes, and inefficient cash drag. These elements, often overlooked in the pursuit of headline returns, act as a silent killer of compounding power, eroding your wealth over decades in ways that are often imperceptible until it's too late. True portfolio optimization, therefore, must look beyond just asset selection and delve into the mechanics of how your wealth grows and is preserved. Strategic reinvestment is paramount. It's not merely about automatically reinvesting dividends. It's about a sophisticated approach that leverages tax-advantaged accounts, whether they are ISAs, 401ks, IRAs, or their equivalents in your jurisdiction, to their fullest potential. Understanding the power of tax loss harvesting, the practice of selling investments that have declined in value to offset capital gains taxes on profitable investments, can be a critical component. This isn't about actively trading, it's about intelligently managing your tax burden to allow more capital to remain invested and compounding. We must also confront the illusion of liquidity. The ease with which we can access funds, while convenient, can also be a significant impediment to long-term growth. Premature withdrawals, driven by short-term needs or impulses, break the vital compounding chain. A truly optimized portfolio is designed for the long haul, a testament to patience and discipline, rather than a readily accessible savings account. Consider compounding as a snowball rolling downhill. Taxes and cash drag are the friction and the obstacles that slow its momentum. Optimization is about clearing that path, ensuring the snowball grows larger and faster, unhindered. This requires a deliberate structure across different account types, a clear understanding of capital gains versus income tax implications, and the automation of reinvestment strategies to keep the engine of growth running smoothly. We often approach portfolio rebalancing with a simple calendar in hand. Annually, perhaps semi-annually, we return our allocations to their target percentages. While this static approach has its merits, it fundamentally fails to account for the dynamic, ever-shifting nature of financial markets. It's like a ship captain who only consults their watch, oblivious to the changing winds, the treacherous currents, or the looming storms on the horizon. True optimization requires a more adaptive, responsive strategy, regime-based rebalancing. This approach shifts the focus from arbitrary time intervals to observable market conditions. Instead of rebalancing simply because a year has passed, we adjust our portfolio allocations based on evolving economic environments, shifts in market sentiment, and changing correlations between asset classes. This is about recognizing that the underlying drivers of market performance are not constant, and our portfolio should reflect that fluidity. The behavioral trap of inertia is a significant hurdle here. The comfort of a static, predefined plan can lead us to resist adjustments, even when market evidence screams for a change. This adherence to an outdated strategy can lead to underperformance as our portfolio becomes misaligned with the prevailing economic regime. A practical framework for dynamic rebalancing involves using tools like volatility bands, which signal when an asset has moved too far, too fast, and correlation matrices to understand how different assets are moving in relation to each other. Economic indicators can also serve as crucial triggers. By systematically integrating these signals, we can implement a rebalancing strategy that is truly responsive, ensuring our financial vessel is always adjusting its sails to harness the most favorable winds and navigate around the most perilous storms. This is not about market timing, it's about intelligent adaptation. We've journeyed through the core principles of sophisticated portfolio optimization, moving beyond the simplistic view of spreadsheets and endless diversification. We've explored how to engineer resilience with tail risk hedging, harness superior returns through factor investing, deploy concentrated conviction with rigorous analysis, supercharge compounding with tax efficiency, and adapt to market shifts with dynamic rebalancing. These aren't just isolated tactics, they form a cohesive system, a strategic architecture for building sustainable wealth. The overarching theme is clear. Portfolio optimization is not a static event, a set-it-and-forget-it exercise. It is an ongoing, dynamic process that demands data-driven insights and a steadfast willingness to challenge conventional wisdom. It requires us to be architects of our financial future, not merely passive occupants. As Warren Buffett, a titan of long-term investing, famously stated, "Our favorite holding period is forever," while perhaps not always literal for every investment. This sentiment powerfully underscores the importance of building portfolios with a vision for enduring compounding and sustainable growth. These strategies are the blueprints for that enduring structure. Now, the true power lies not just in understanding these concepts, but in their application. I encourage you to review your current portfolio through the lens of these 7 strategies. Where can you enhance resilience? Are you capturing the full potential of market factors? Is your capital allocated with conviction or spread too thin? Is your compounding engine being choked by unnecessary taxes? Is your rebalancing truly adapting to the market's rhythm? You possess the knowledge, the tools, and the critical thinking required to move beyond mere guesswork. You have the capacity to architect a portfolio that is not only optimized for growth, but is also resilient, adaptive, and fundamentally aligned with your long-term aspirations. The journey to sustainable wealth is one of continuous learning and strategic action.